There it goes. Alrighty, so I've got, we're here. We were teaching classes this morning, so we're still in the training room. We let go about 10 minutes ago. Otherwise, we were going to be doing this while we're teaching classes. So the questions that came up this week that we're talking about here, we've had a lot of questions about interest rates lately. And so I believe Jackie Payne, who is with Guild Mortgage, was going to be popping on here this morning to talk about some of that stuff. So we'll see if she jumps on, and then we'll let her in. But the Fed raising all of their rates, we actually had a lot of our rates over the last couple of weeks down in the lower fives, which was really good. They were trending back down. And then in this last week, they've spiked back up to about 6 again. And so we're still on a little bit of this trajectory that's bouncing. And a lot of that bouncing is giving our buyers a sense of insecurity in making that decision. And so that's where a lot of our lower demand is coming from, are those higher rates and then the bouncing rates. So buyers aren't feeling particularly comfortable at a payment at 5% when they go looking, and then by the time they find their house, they're locking at 6%. That changes things drastically. And so with that bounce, we expect the next couple of weeks to be a little bit slower again. And let me see if Jackie can pop in here. Nope. And so that bouncing is giving us a little bit of grief. So with the bad inflation news this week, regardless of what the government wants to spin it at, it wasn't super great news. So 8.3% caused the rates to go back up to try to slow the economy even more so that we can reduce that inflation number. So it's all kind of tied together. So if we're talking big picture wise, that's what's going on in our world. So as you're looking to buy something right now, if you have really big down payments and aren't super rate conscious, get after it, because there are deals to be made, and a lot of buyers are sitting on the fence right now waiting to see what happens. So we don't have any kind of crystal ball. We're expecting the Fed to raise rates again, and then we'll see how long it lasts. But every time that there's been some sort of economic recession, whether you choose to say that we're in one or not, to combat inflation, rates go up and they come down just as sharply. So we'll have to see how long they go up for. It might be this whole year. And so then we would expect the end of 23 for those rates to come down. But prices may or may not level off. So right now they're kind of at the rate of inflation. We're seeing them be about 8.3, 9-ish, 10-ish%. So it's really close, which is indicative of a balanced market. And so last year's 30% appreciation totally gone. This year we're expecting somewhere around 10-ish. And we're right there. And so as that trend line continues, next year your home will be 10% more expensive. Even if that rate comes down a little bit, are you really saving any money? You can always refinance later, which is why people are saying date the rate so you can refinance, but marry your house. So while there's a ton of opportunity right now, we have 19,000 homes on the market, which we haven't seen, I think, since 2015, 2016. But when you have that many options, you can go and find a house that you really, really love. And hang on Biz page so she can chime in. Shoot. What happened here? My Facebook Live went off. Let me see if I can pull that back up here. Technical difficulties today. Technical difficulties. Sorry, guys, got booted off the Facebook Live there. So we were talking about interest rates and things like that. The other question that we've gotten a whole bunch in the last little bit is how much money does it take to buy a house? So we are still operating on FHA standards. So an FHA loan is 3.5% of your purchase price. Our average home right now is about $450,000. And so that is roughly like 15 grand would be your down payment. We do still have down payment assistance programs that have come back in. So those, in essence, would pay for your down payment and maybe a portion of your closing costs, maybe not. But in theory, it's like a 0% then in to buy your house, but the rates are higher. So if you're incredibly rate conscious, it's probably not one that you want to do. Another option that we're seeing a lot of people do is getting in a conventional loan for 3, 5, 10, 20, or whatever percent. But 3 and 5 are the lowest that I know of. And so 5% of 450 is a little over $20,000 to buy a house. And what we're seeing them do then is negotiate for some of those closing costs to buy the rate down, so the payment is still where things might have been maybe 6 months ago, maybe a month ago. Get that down a point. And so that can be a little bit expensive, and sellers can contribute up to 3% towards your closing costs, which can go towards those rate buy downs. So there's some strategy and some choices to make whether or not that's a 2-1 buy down, which means that you're buying it down 2 points the first year, 1 point the second year, and then paying the full high rate on year 3. Or if you're buying that down permanently for the life of the loan, so the next 30 years, or if you get a 2015, whatever. So there's some strategy that can do that. So Jackie, if you're on here, just request to join, I think, is how you do that. And so let's talk rates again. Do you see that? So we'll keep rolling. VA loans are a 0% down loan, so you don't need to bring anything to the table. There is a VA funding fee that gets tacked on. So you would basically, 450 is our average price. That VA funding fee would go over, and you would actually be financing like 450, whatever that funding fee is on top of that. But that you don't have to bring anything to the table. And as our market has slowed down and a lot of the multiple offer situations are gone, then you have a lot more chance of success using a 0% down loan or some of these lower down payment loans. You don't need to have $100,000 in extra cash anymore to be able to get a property. So there's a lot of opportunity there for our buyers and a lot of homes and a lot of choice for you to kind of shop between. So that's where we're seeing a lot of opportunity happen on the buy side. On the seller side, if you need to sell, then let's sell. If you're testing the waters, this isn't the market to test the waters in. We also are not reaching for that sky high price. So an example right now is we sold a house this week across the street on a superior lot, not a superior house by any means, but superior lot for $860. The neighbor across the street wants to list his house for $1.6. And my answer to that guy is dream on. You missed your mark to even try to get something like that. And we're years away from that house being worth 1.6. Sorry. So even though it's something that you really, really want, you're going to say the market is crazy. Everybody wants this house. People from California are moving with cash in their pocket. They don't care. They love my house. They'll pay it. Maybe, but the value isn't there right now. And the opportunity cost is not needed to overpay on a house by almost double to be able to secure something. So when you're looking at a lot of things come down in price, that's actually a list price and not a true value of a house. So a lot of people are asking us right now, market's tanking. I see everybody dropping their prices like crazy. Well, that may be, but sellers have been shooting for the moon for the last, year, maybe. They've been shooting for the moon, and the buyers are not up in the skies anymore. They've come back down. And so the list price has to come back down and meet buyers and meet that true value and meet what that appraiser is going to appraise it at. So we're coming back down to normal, you guys. We have to, go backwards 5 years, 10 years, and remember what normal looked like. And a lot of that crazy overreaching on your price as a seller, that isn't happening. So if you're a realistic seller, you have a real need and you want to sell now, then it's not going to be a tomorrow sale. It's probably going to be like 1, 2, 3 months on the market, but you'll get the true value of your house. We're just not going to be over and above like it's been for the crazy bit of time. We haven't seen those values drop yet. So that's kind of an interesting thing. Homes are holding that value. We're seeing the list prices come back down to what that value is. So if you have questions about that, I know it's kind of a weird concept. Let me know. Phone number to reach me is 480-518-9907, or feel free to email me at Chelsea, CHELSEA at yourreddoorteamaz.com. And any of those questions, we'll jump on here in another couple of weeks again and answer the questions that we've seen from conversations and clients that we've been talking to. So That's kind of where we expect the market to go over the next little bit. It's going to be pretty level and pretty steady. We've hit balance. So our buyer demand is still just a touch higher than our seller supply, and it was climbing over the last couple of weeks. Rates again went up in the last couple of days, so we'll see if that demand drops back down again to meet our supply line. But overall, we are at balance, and so that doesn't mean prices are dropping. Sorry, my thing is buzzing. Jackie's texting me that she wasn't able to pop in, so sorry. The thing at balance means that we will appreciate at the rate of inflation. And so that's why our appreciation levels are hovering 8 to 10%. In a seller's market, you appreciate above the rate of inflation, and in a buyer's market, you appreciate below the rate of inflation. And so that's kind of where we are in our world right now. So that's why the 8 to 9% is pretty spot on. That's right where our inflation is, that's right what our market is, and that's right where our house appreciation is going. So if you guys have questions about that, again, let me know. I am happy to share. So we will talk to you next time, and send me your questions.